Are we at an inflection point? Are we at the moment, of course, in tenterhooks with the Federal Reserve? We've got geopolitics, of course, there's a new alpha here in the market too. So what gives?
Right, so I think we are at an inflection point here, right? So during the pandemic, we learned about the potency of monetary stimulus at this scale, right? When we saw the V-shaped rebound during a period where the economic activity was very, very diminished. And we are about to learn today what the withdrawal symptoms are. And that to me means a significant scope for volatility. We've seen that already. I think more will come. And I do think that it will be very, very difficult, if not impossible, for investors to try to trade these swings. And this is the time to examine leverage and margin risk in portfolios to make sure that portfolios are resilient enough to withstand these swings. And I do think that structurally, the bull market is still intact.
But there are many headwinds here, and you've mentioned a few of those. When we look at the Fed, that's one thing, of course, but on top of that, we've got lots of volatility. But could earnings underpin the rally? Absolutely. Now, Rishi, we are moving into a later, more mature phase of this market cycle, right? So earlier, what was happening was that the rising tide of liquidity was lifting all boats. And frankly, everybody was looking like a genius. But we are now transiting into a more mature stage where money is tighter, right? But the underlying economic activity is going to be fairly strong. So there will be a rotation from the new economy to the real economy names. And I'm talking about financials, industrials, consumers, real estate, and energy sectors here. And there's still tremendous value in these sectors right now, in my view.
It is about surging yields. When you take a look at surging yields, what are they saying about the kind of returns you can expect from the S&P, for example, over the next 6 months?
I do think that over the next 12 to 24-month period, returns will still be positive, but nowhere near as high as what we saw over the last 24 months. Now, historically, if you look back, markets, the bull market does not end during the first few hikes of the hike cycle, right? That comes much later. So we are going to swing. I think we will recover, but investors should be positioning for real economy stocks, and I think that will lead the market in the second half of this year.
Eli, I want to take a look at Chinese stocks. There's a divergence in terms of whether it is time to buy or not. Goldman among those who say, you know what, valuations looking very cheap, but Morgan Stanley is saying that, you know, the stocks have not bottomed. Don't do it just yet. Your take on it?
Well, I think everyone's looking for more confirmation, more clarity, and more positive news. But frankly, you know what? Let's ask ourselves, what are bottom dynamics? Bottom dynamics is when the positives usually balance out the negatives, right? And I think we are probably close to a bottom for the Chinese equity market. And importantly, we do know that policymakers are entering into a new easing cycle here. Historically, that has catalyzed positive performance. So I think this is the time to be looking very closely at the Chinese equity markets.
So, Eli, what you're saying is no time for anybody to be a hero?
Right. So absolutely right. There's a saying that goes in markets, there are no brave old men, right? So I think prudence will go a long way here. And, you know, to go the distance, you have to survive over the short term. This is the time to be looking at portfolio resilience to make sure that, you know, investors can withstand the swings that will come ahead.